Hi, my name is Nicklaus. I'm a current master's student in Cs and I'm majoring in computer science.
Hi, I'm Jonathan. I'm also a master's student in computer science, focusing on machine learning.
Today we'll be sharing our presentation and our project on investment strategy, AI trader for stock markets. So our topic is combining macroeconomic data, formulaic alphas, financial text, and artificial intelligence. So what we're trying to achieve is returns forecasting and position sizing using machine learning, followed by explainable machine learning for diagnostics. So we want to build a smart trading algorithm that utilizes a variety of data and techniques, tweaks bet sizing according to the market regime, and utilize explainable machine learning in order to elucidate the decision-making process. We think that this will be a very crucial research. It'll be an end-to-end trading system for AI, and it presents many different interesting problem sets, such as the combination of different alphas, how to bet size, which is not very well documented in financial literature as well. We will focus on S&P 500 companies. So first, you want to scrape financial news, perform sentiment analysis, gather market data, and construct formulaic alphas. Formulaic alphas, we mean traditional alphas like momentum and reversion. We also combine these two NLP signals and traditional alphas together with macroeconomic data using machine learning to forecast 1 week to 1 month returns. So you want to predict the direction of the signal, long or short in equity. We also want to overlay this with a machine learning algorithm for bet sizing that adapts to the environment and learns to optimally size positions in the portfolio. And lastly, explainable ML. So below you can see the pipeline. So these are our contributions to financial literature. First of all, a lot of existing literature introduces survivorship bias and look-ahead bias. Our contribution is to obtain historically accurate constituents, elucidate steps to construct these constituents, and also use purge k-fold cross-validation. This is the gold standard for testing and simulation. So we will show in our report how to obtain historical index constituent data by tracking S&P 500, the Dow Jones Index release. We will also source both active and inactive tickers from Yahoo Finance and investing.com. Secondly, existing literature uses one source of alpha, for example, only news or only economic data. Our contribution is to use multiple sources of data. And we found that macroeconomic variables are the strongest predictor, followed by alphas, and lastly, news. Next, a single source of news for sentiment analysis is typically used, for example, using only news from Bloomberg. What we contribute is comparison of multiple news sources. So we found that finance analyst news from Seeking Alpha is much better than news from finance firms, Yahoo Finance, and from financial news from non-financial firms, for example, New York Times. Also, in sentiment analysis, it combines financial methods and compares these typically to non-financial methods. We compare all of them. So we compare Finberg, financial lexicon approaches as well, and we also explore ChatGPT. We found that Finberg is the best, followed by ChatGPT, and lastly, traditional lexicon methods. Also, a lot of existing literature uses fixed window method for returns. We document triple barrier method for small stable returns, which results in strong model performance. And lastly, machine learning and reinforcement learning for bet sizing. This is not too well documented, and we found that bet sizing improves the performance of the P&L. So this is an example of how we've constructed our historically accurate S&P 500. So you can see from the top line, the orange line shows our coverage across time. So you can see from 2010 onwards, their coverage is near perfect. And our research results can thus be trusted since we have handled for survivorship bias. So our universe uses the historical S&P 500. We took the current index from Wikipedia, which tracks the Dow Jones Index releases. So this shows our historical S&P 500. And we are also given the additions and removals across time. So we'll walk backwards in time, adding and removing the constituents as required, and we then get our historically accurate S&P 500. So the blue line shows the coverage of S&P 500 if you only use the actual latest constituents. So only 300 of the S&P 500 has actually been in the S&P 500 since 2010. So if you use only this current S&P 500, you would have survivorship bias. In total, 752 tickers were required to construct the historically accurate backtest. So this is an overview of the data. We have news sentiment from 3 different news sources. We also have a timeline of 1 day. We constructed 67 formulaic alphas from market data. And the last 4 is macroeconomic data. So real GDP, break-even inflation, 10-year minus 2-year yield, and the purchasing managers index. So here we are also accounting for time lags. We want to prevent all possible data leakage. And we only use data when it's available to be used by the market. So this is an example of feature engineering for macroeconomic data. So we use the GDP 2-quarter growth. For yield, we took the 10-year yield minus the 2-year yield, which is a forward-looking indicator. We also have another feature engineered, which is the change in the 10-year minus 2-year yield. For the purchasing managers index, we have the forecast level. We also take the 3-month change in PMI, and we also take the PMI surprise momentum. So what we take is the actual PMI minus by the forecast, and we take a rolling 3-month average. Lastly, the inflation break-even rate, which is forward-looking expectations of inflation. We take the level and the change in expectations as well. Now we go through our natural language processing features. We use news article headlines, and we filter for relevant content using metadata. For example, for the New York Times, we use only the business day section. So for Finbird, sentiment scores, it gives 3 different scores: positive, neutral, and negative. So on the left-hand side, you can see some examples of the Finbird sentiments. Meta price source on earnings beat is very positive, and Goldman reiterates neutral, or Meta gives neutral, and Meta share price sinks gives the Finbird negative. We also use the Logan McDonald dictionary. This is a financial dictionary that many industry practitioners actually use. And there's a word count of negative, positive, litigious, strong modal, and weak modal words. And lastly, we also use ChatGPT only on New York Times, which will take us 7 days in total. So this was really our stretch goal using ChatGPT. You can see with some clever prompt engineering, you can get ChatGPT to give you a scoring. So we have prompted it. We give it some context. It is a hedge fund analyst covering stocks. And you can see that based on the news, is giving quite accurate sentiment scores. So Apple sales in biggest fall since 2019 is negative, and Meta sales saw gives plus 100 for sentiment score. So here you can see ChatGPT versus Finbird. We use ChatGPT's most powerful model, Text DaVinci 003, and this is using GPT 3.5. Because weaker models can only answer a positive or negative, but this can give some magnitude. So you can see on the left-hand side, ChatGPT tends to give positive sentiment scores. So you can see that there's a real peak at 50 sentiment, while Finbird actually tends to classify it as neutral. So this shows the Finbird histogram shows positive. So 1 meaning is highly positive, 0 meaning it's either neutral or negative. And you can see the Finbird tends to classify it as neutral or negative. And we think on a practical sense, using this for trading, it's quite inefficient for HFT, but there's a reasonable time lag if you want to use it for daily trading because of the API call limits. Lastly, our formulaic alphas. WorldQuant published 101 formulaic alphas. These are explicit formulas for real-life trading. The average holding period is short, and the average pairwise correlation is low, which means that we capture quite a fair bit of the market breadth. Returns are also rather correlated with volatility. So we implemented 67 of the alphas. We show some examples here. So this is our target variable for returns. It's called the triple barrier method. So how we would define it is we have a top barrier, a vertical barrier, and a bottom barrier. The vertical barrier is the maximum holding period. So in our research, we define it as 21 business days, which is about 1 month. We have a top barrier defined by 0.7 times the volatility, which gives you a top barrier. And the bottom barrier is 0.7 times volatility, and you take the negative. So that gives the bottom barrier. So this represents our take profit and our stop loss. And this helps to capture trends as well. So for example, if you were following academia, most common practice, which is taking the fixed window returns, in the above scenario, you can see that it's minus 1% returns. But this actually results in loss of information and might introduce noise. So you can see that there was very strong positive returns, which was not captured. But because we're using the triple barrier method, where we define the upper and lower bound, we have captured that positive initial trend, and we classify this instance as a +1. You can see within, as you can see from the box that we've drawn. In order to get an unbiased estimate of model performance, we have used something called purge cross validation. So here we maintain linearity of time. So for example, for fold 1, we're using 2010 to 2012, and fold 2 is using 2012 to 2013, so 2 years each. But in between the folds, you actually need to remove some data because our target variable has overlap going into fold 2. For example, on 31st December, your forward 1 month return is looking into January of the next year. So you have to remove this to prevent data leakage. So now this can be used for parameter tuning, and you can visualize in-sample performance for a portfolio that you construct. So we use 5-fold purge cross-fold validation, and the cross validation is done on our in-sample, which is 2010 to 2019. Our out-sample is 2020 onwards. So we've used 6 different machine learning models, or we attempted to, because the support vector machine took too long to converge. We're hoping that high-performing models will enable us to construct an ensemble that makes robust predictions, and we use grid search based on the parameters above. So here you can see the model performance. Light gradient boosting has performed the best. You can see the parameters are documented in this column. Accuracy score of 41%, and this is compared to roughly 33% accuracy for the dummy classifier. So if you classify everything as 1, everything as 0, everything as -1, you'll get accuracy of 33, but light gradient boosting has gone up 41%, which in our opinion is quite good. Sharp ratio of 0.97 as well. You can see that light gradient boosting did quite a fair bit better than random forest in terms of accuracy, so a whole 1% difference. And also light gradient boosting is much faster, so we think it's much superior. So model evaluation, you can see that our out-of-fold accuracy, you can see on the left-hand side for the accuracy heat map, LGBM is the most consistent throughout all the folds and across regimes. So fold 2 was particularly challenging for our model. And on the right-hand side, you can see that the prediction correlation of the models is rather low. So here for feature importance, you can see that we have some pretty interesting insights. Forward-looking macroeconomic variables are the most impactful, so they're all the way at the top. Alpha factors came in second, and lastly, news sentiment. Out of news sentiment, you can see that analyst news is the most powerful. You can see analyst news Finbert around the middle, 74, with an importance score of 74. ChatGPT is somewhere in the middle of the textual features, and the lexicon method you can see is dominating the bottom part of the feature importance. So this was the least impactful. So now we go on to look at the model performance in terms of returns. So you can see for here, we constructed a portfolio using out-of-fold predictions. For example, the 2010 to 2011 prediction is using the model trained on 2012 to 2019 data, and we construct a long-only portfolio that holds stocks as long as the model predicts one for the stock. So because we have accounted for survivorship bias and we are using out-of-fold predictions, we have very high confidence in our results that is better than S&P 500. And S&P 500, as you can see here, is 0.78 Sharpe ratio, and it's a line that is the lowest out of all the models shown here. We select light gradient boosting as our final model to use, seeing that it's rather similar to random forest, but it's much faster and its accuracy is a little bit higher. So lastly, we want to use another machine learning model for bet sizing. So we define a profit variable, 1, if the direction model results in profit. So if it predicts as 1 and you actually profit from that trade, and 0 otherwise. So we explore using light gradient boosting as this bet sizing. So the profit is the target variable, and we fit the same explanatory variables as the X variables. And then we obtain the predicted probabilities of each stock for each day, and we only trade when the predicted probability is more than 0.5, and we bet size according to the remaining probabilities. For example, in this table, you can see stock 1 is 0.4, stock 2 is 0.5, and stock 3 is 1. We will not trade stock 1, and we'll split the bet size according to the probability of stock 2 and stock 3. So here's our final models. You can see that our bet size portfolio is doing quite a bit better than the portfolio without bet sizing. So we have a 0.92 Sharpe ratio compared to 0.86. And note that here we're also looking at the out-of-sample results. So this is showing 2010 to 2023 February. So the portfolio has 0.92 versus S&P 500 is 0.65, and our information ratio is 0.75. So you can see here from the bottom chart, it shows the cumulative normal returns. If you invested at the start of 2010, our portfolio would have obtained 772% returns with bet sizing, compared to S&P 500 of 261% if you had invested at the beginning of 2010. So we do show that there's very huge opportunity for systematic managers and robo-advisors by combining alphas, selecting new sources, and bet sizing accordingly. And there's very large economic profit. So now I hand over the time to John.
Cool. Well, thank you for that, Nicholas. So, from here on out, after we basically built out the models and got some promising results, we wanted to be able to inspect how our models were kind of working under the hood and use explainable and interpretable ML to be able to check for any biases and errors and also get a better understanding of what is driving our model's success. We did this for a few reasons, the aforementioned one, as well as to be able to build user trust. People would be presumably investing money with our solution, and we would want them to have a good understanding of why our model is driving good returns. So that way they have more confidence and don't necessarily get shaken when things are going poorly. So we did all this by using Lime specifically, right? So Lime, what we did, we applied it so on a per instance basis. That means across every date and every ticker. So that kind of forms the unique tuple that gives you a specific prediction explanation. And Lime kind of works by basically taking an original sample, perturbing that instance in a variety of different ways, and then feeding those perturbed instances through a more simpler model to then try to reverse engineer what it is and which factors and features are driving that prediction. In our case, we're predicting actual returns. In this case that we have here on the slideshow, it's predicting a classification for an image, but it's the same sort of concept I think this illustrates. So we did that, and we then used that as part of our dashboard that I'll show later on. But Lime was how we decided to do the interpretable explainable ML. And then we did a lot of exploration on bet sizing prior to settling on the model that Nick had been talking about. Prior to this slideshow, it was using reinforcement learning, which we saw some pretty promising results for. We trained originally 5 different agents, which are listed here. We saw some pretty weak results, I would say, comparatively to what we saw from just buy and holding of an index. And we did that by basically modeling the state space, which involved getting all the daily prices for a stock using traditional indicators like MACD, RSI, and so forth, as well as using what's called a turbulence index, which kind of gives you a better overall idea of what the sort of market in general is doing and how volatile it is. So it can use a sort of a smart switch to determine whether or not it's a more risky or more safe time to bet on. And we did that for basically pick an allocation of, let's say, $1 million, a percentage for every stock in our universe. Now, while we didn't see necessarily promising results with the individual agents, but once we used an ensemble, which involved 3 of those individual agents, and we trained on a variety of market cycles, most notably the complete market cycle. So trained over about a 10-year period and tested on about a 4-year period versus just a bear cycle, which is a little bit more recent. And so we were trained on like a 2-year period and tested on a 1-year period. We saw that the ensemble performed dramatically better than the individual agents. And on top of that, we saw that the ensemble at least kept pretty good pace. I wouldn't say it was significantly better or worse than the S&P 500 complete cycle. It has a higher Sharpe ratio, slightly higher cumulative returns, and a little bit less volatility. But in backtesting, it was kind of on discount to your results a little bit. So, but we were encouraged by that. And then we also saw the bear market outperform pretty significantly with a much higher Sharpe ratio, better cumulative returns, and lower volatility as well. So we saw some promising results there. We tried to incorporate this into our final solution. Ultimately, we had to scrap this, which is unfortunate because the package we were using, which is FinRL, is very specific about what it takes. It doesn't seem to allow for a lot of flexibility. We had done a lot of work, as we talked about earlier, on NLP and doing the traditional alphas that we use from World Quant, and we wanted to use those as our state space variables. But the package just forces your hands to use the turbulence index, to use those traditional indicators. And on top of that, we were having memory issues where we couldn't train on more than, I don't know, 20 stocks. So we really wanted to allocate across a basket of, upwards of 300 to 400 stocks. So ultimately, it just didn't work with our solution, and we had to put this research aside. I think in the future, when we expand upon this, we would like to come back to this. I think there's still some maturation that needs to happen with the toolkits of reinforcement learning, and specifically the FinRL package needs to be more extensible. But yeah, that's kind of what we did here, and we saw some of the results, but just couldn't put it into our final solution. So after we did all that, we wanted to deploy this into a more production-like environment. So we built a rudimentary data pipeline where we could basically continually train our models. So we have these data sources. So we have a SNS topic event that gets scheduled and fires, I think, at 22 hours UTC every day. That triggers the SNS topic, which then fires off the Lambda, and then that activates the SageMaker instance. SageMaker is just a way to run our Jupyter notebooks in the cloud. That does a few things, right? It fetches the most up-to-date market data, which is why we have it running after market close, and does some alpha engineering using all of the pre-processing libraries that we built and methods, dumps those into S3, and then basically looks at the current date and looks back about 3 years, pulls all that data, all of that text data, macroeconomic data, and so forth that we use, does a whole bunch of model training and cross-validation, and eventually selects a model, gets a final model, trains that one after it's been tuned with the hyperparameters, and then predicts a bunch of returns, and dumps all of that into S3 for our dashboard purposes that we'll show in a moment, as well as does all the explainable ML stuff so that we can have the most up-to-date predictions and explainable ML stuff. So ultimately, all that lands in S3, and then we have a website that's hosted on EC2 that's built through Python and Dash Plotly, and it's able to read from S3 and then present all of this data. And I'm going to show that here in a moment. And the end user is able to interact with that so they can see how they are performing if they invested in our portfolio and understand what's driving our predictions, as well as how much alpha we're providing above the market. So here's some screenshots just kind of proving out the different pieces of what we did. This is the SNS topic and the rule schedule. This is the Lambda on the right-hand side. On the left-hand side, we have the S3 folders. There's a whole lot of stuff in here, as you can see: train test splits, results, investing.com, textual data, our dashboard data, which is where we dump our up-to-date training and results, the alpha augmented market data, and so forth. And on the right-hand side, we have just a SageMaker notebook instance server. So lastly, we built a UI that's hosted at this URL. It has a bunch of stuff on there and a lot of different capabilities in terms of filtering. So you can look at specific date ranges, you can compare things against different benchmarks, you can filter by a specific stock, which we call an asset, or you can just look at the overall portfolio. We have daily returns, cumulative returns, and cumulative log returns, as well as daily cumulative alphas against various benchmarks. A note about alpha, I'm not sure about the familiarity of our audience, but alpha is basically just measuring excess return over the market exposure. So that market exposure is typically quantified by a variable called beta. So if you have returns which are equal to beta times the benchmark plus alpha, we're interested in knowing how much extra value we're providing over just investing in the S&P 500 or the NASDAQ or the Dow Jones, which are the specific benchmarks that we calculated against. And then you can basically rearrange this formula to solve for alpha. And then the last thing you do is calculate beta, which is looking at the correlation between your portfolio and the benchmark, timesing by the portfolio volatility and dividing by the benchmark volatility. And then we also have our visualized line explanations across all our predictions on this website. So I'm going to navigate to that really quickly. So you can see here, I'll scroll down and kind of show all the different pieces. This is the daily return. You can hover over any part of the graph and get a specific data point that shows you what that value was at that point in time. Here are the cumulative returns. You can see that we have our cumulative returns is the blue line, and different benchmarks are S&P 500 red, the light green is the NASDAQ, and the purple is the Dow Jones. Cumulative log returns follows the same legend and has just a slightly different graph. Then we have alpha, right? So this is the daily alpha over the benchmark, and you can select your benchmark, your date range, and the asset, as well as the cumulative alpha, so how that accrues over time, basically, with the same filtering capabilities. Lastly, we have the Lime explanations, where you can filter by an asset and a date and kind of understand what's happening. So I'll show you that right now. You can see that it's responsive. If I choose a different date or something, let's go here. And then you can see at the bottom, we show you what we predicted, what we predicted and what the actual target variable was. So in this case, we had a correct prediction, and here's what drove that success. And then going back up here, right? So I could choose let's just do Apple again and compare it against just the NASDAQ. And you can see that it filters against that. And down here we have, let's do Meta. And there's some gaps in the graph just because we weren't always necessarily invested in Meta. So there's some days where we removed our position for Meta, but it shows you that it's responsive. So that's the UI that we built. So I'll navigate back to the slideshow. And then just in terms of kind of reflecting on everything that we've worked on and all the stuff that we set out to do when we first originally planned this project, I think we did quite a lot of things and we achieved most of our goals, with the one lone exception being the reinforcement learning model, which I put in light green because we did a lot of work there, just weren't able to incorporate to our ultimate solution. So kind of we did a little bit of work there, but wasn't able to necessarily get it over the hump. But everything else that we set out to do, I think that we did. And yeah, that's our entire presentation.